What would you tell people to do with the yields on offer in this environment? Where should they go?
They should extend their duration.
Really?
And it's been most challenging conversation I've had with clients recently because it's so safe to sit there in cash and 5% and change short term. But if you're trying to achieve a durable, sustainable stream of income, especially for our retirees, our pre-retirees, if you're going to be blessed to live on this planet for another day, you need long-term duration or at least intermediate-term duration. And so some sort of a balance is really what we're after.
And I have to imagine most of these things you're talking about hold to maturity. We're not talking about taking on market risk here. So for you to tell someone to go out to 5 years or 10 years or even 30 years at 5%, what's the biggest pushback you're getting?
I'm not going all in on one maturity. I'm creating portfolios really that are balanced. I'm even barbelling them a little bit with keeping some on the short end. But our thoughts are also that real yields are going to come down. And so we feel like we're at the peak of the rate cycle. We feel like we could get equity-like returns for the next 12 to 18 months, somewhere in the double digits, if you buy bonds now. So if you have a portfolio that is, highly diversified with different maturities, we like high quality. That's where we think you should be.
Andy, same for you?
Very similar position for me. And I think the biggest challenge investors are facing is just psychology and perception of value. When the yield curve is flat, when it's inverted, the bond market is upside down. People see similar returns in cash, which they view as less risky, as they do in bonds, which they view as more so, especially after the last 2 years. Here's what I think they're missing. I think what they're missing is there's value in making a commitment. If you like today's yields for 3 months, why not 3 years?
Right.
Why not something longer?
That's why I'm curious what the pushback is. Do people think that inflation's going to be so high? Like, especially if I've looked at, they pay 30%, 30 years at 5%, but I mean, you are at some point going to lose your real purchasing power. Once
bird, twice shy. I think a lot of investors are looking at what happened to them last year, looking at mark-to-market returns that are negative again this year, and feeling like they want to see the safety of a known thing in 3 months. And what I'm trying to encourage them to think about is, why not have a known thing for 5 to 10 years?
Right. And I think we're headed, correct me if I'm wrong, Angie, for 3 years of losses in bonds, which maybe has never happened before. So understandably, people are a little bit nervous.
Yeah, well, and we had that 2021 period of equities that was pretty rough, too. So people went from, having goals to have of like higher yields and higher returns to just preserving capital and sitting on the sidelines. And now they've reduced their expectations and they're very happy with that 5%. But
what about, we have these headlines about Chevron and Exxon, and we know what some of the yields are and the energy story. Ever look to send people there instead of bonds? Or, it's not that you can't do a little bit of everything, but where's the relative
balanced portfolio
value?
for sure. We still like equities. For the long term, we actually think bonds are going to outperform equities in the next 12 to 18 months, but we do like equities. Balanced portfolios, we're favoring, indices that are market weighted. So, we're not necessarily high in on the high beta names, but we're also hedging. We like private equity, we like hedge funds, we like covered calls and structured products. We think we're back to balanced portfolios to smooth out returns over time.
Do you think, Andy, we're going to be in a recession? And that's what they've been busy on Twitter this morning. Bill Gross basically said Q4 recession, doesn't like what he's seeing across some of the auto delinquencies and those parts of the market.
So I think the Fed has the bond market by the horns. It's really driving the next big move. And I think the Fed is responding to 2 things. The first one is the inflationary outlook and where inflation actually is. And the second one is unemployment. Inflation has been slowly but surely coming down to that 2% level. So I think as long as the economy continues to make progress towards 2%, as long as we don't see any unexpected spikes, particularly in core inflation, the Fed has a lot of room to leave interest rates alone, potentially reduce them a little bit. But the biggest one to watch is the employment market. We have been in a very unnaturally tight market for labor for going on 2.5 years now. The Fed needs to see softening there to really give themselves room and flexibility to reduce rates. I think those are the numbers to watch. Will we see a traditional recession the way that you and I normally define it? Perhaps not. This is a very unusual environment that we're working in. So instead, watch not so much the headline data, watch inflation, unemployment.